Thank you for coming today. We will be discussing real estate investing tax and legal strategies. This presentation has been updated to include tax updates from the One Big Beautiful Bill that was recently passed by Congress and signed by Donald Trump. So today we'll talk about our learning objectives. Why are we here and what do we want to learn? So the first is financing real estate purchases, understanding legal entities for real estate investing, how to calculate rental profit or loss, and understanding what depreciation expense means. Tax reduction strategies for rental profits and losses. Last, I'm going to give bonus tips and how to prepare for success. So the first question I ask clients is, why invest in real estate? What's the point? So we want to build wealth and long-term financial security, not just for ourselves or our spouses, but for our future generations. We all want reliable income and cash flow. Tax advantages. We don't like giving money to Uncle Sam. We want to keep as much money as we can in our pocket and invest for ourselves. Control and flexibility. When we own a house, we can live in it, or we can decide to convert it to an investment property in the future. The ability to borrow against equity. So when we have a property, we can take a loan against it and invest further. Lastly, we want to hedge against inflation, which has become honestly a really big problem the last 4 or 5 years. So the first topic we're going to jump into is financing real estate purchases, which is a fancy way of saying, how do we want to buy the real estate property that we're interested in? So most of you guys are familiar with some of these, but the first is obviously cash. There's domestic cash, money in your checking account or savings account. Next, we have foreign bank accounts that we can use to buy real estate. Let me just hide this pointer. First, cryptocurrency. So believe it or not, you can actually go into escrow and do an all-cash offer with Bitcoin or Ethereum in today's economy. Next is rich friends and family gifting. Hopefully we all have rich friends and family. When family members do give us a gift, this is very important. Donors, the person giving the gift, must file a gift tax return, which is a Form 709, for any gifts more than $19,000 per person. If it's less than $19,000, no gift tax return is required. The gift is not tax deductible to the person making the gift or the donor, and the person receiving the money, the recipient, does not report it as income. And this is a frequently asked question I get all the time. The one thing you have to be very careful about is if you're getting money from overseas, from a foreign individual or a foreign trust, you may have foreign reporting requirements. It may not be taxable, but if you don't report this, there could be very stiff penalties in, honestly, the tens or hundreds of thousands of dollars. Next, a common question I get is, should we liquidate securities? So selling stocks, selling bonds, precious metals, any other assets. Although you can do this, there will be capital gain consequences if the assets have appreciated. There might be alternative tax consequences and net investment income tax. So we should be careful before liquidating assets because of the tax consequences. Next is debt. Many of you are familiar with a fixed rate mortgage. The most common is the 30-year fixed that we all hear about. There's adjustable rate mortgages, which the most common would be like the 5-1 ARM or the 7-1 ARM. What that means is that for the first 5 years or 7 years, the interest rate will be fixed. After that, it'll be variable depending on the SOFR rate. We can use investment capital, so we can pool money from friends, family, other investors, and create a real estate syndicate. And that can be done through a vehicle such as an LLC, which stands for Limited Liability Company, S Corporation, Partnership, or a C Corporation. We can use our retirement funds. So as you guys might know, when you take money out of a retirement account, there will be early withdrawal penalties if you pull this money out before turning 59 and a half. And there could be federal taxes, state taxes, a 10% penalty on the federal, and a 2.5% penalty on California. Otherwise, we can use what's called a Rob's 401k, where we can roll over those funds into a company and avoid taxes. Or we can use a self-directed IRA, and that can invest directly into real estate without having to pay those income taxes or those early withdrawal penalties. So these are two common retirement vehicles that a lot of people are not aware of, to invest directly into real estate without paying taxes on distributions. And of course, we can use any combination of 1 through 6. I did gloss over a seller carryback financing. I did want to spend a little bit more time on that. Seller carryback financing is a very important tool that, if used properly, can save you lots of money. You are ultimately cutting out the middleman, which is the bank. So the buyer is making payments directly to the seller instead of making monthly payments or a fixed amount of payments to the bank. So that's a negotiation that you make with the seller. You control the terms, the seller controls the terms, and you guys reach some kind of agreement. And you can bypass having to give all these annoying bank statements and tax returns, W-2s, and so on. So next we want to talk about understanding legal entities for real estate investing. So like once we've financed the property, we see the house that we like, we can afford it, we have the funds to do so. How do we structure it? So the most common is buying a property under our individual name or revocable trust. Next is an LLC. If there's only one owner, then it'll be a single member LLC by default. If there's more than one owner, it'll be an LLC taxed as a partnership by default. We have an S corporation or an LLC taxed as an S corporation. And then we have a C corporation or an LLC taxed as a C corporation. And I'll be talking about when one might be better than the other. And pay attention, because I've seen clients make lots of costly mistakes, and you'll see why shortly. So first, let's talk about buying a property in your individual name. So this is the most common when we're trying to buy a primary residence or a secondary residence, so a house that we're using for personal purposes, not as a rental. The downside with buying a property under your personal name or a revocable trust is that there's no limited liability protection, and I'll be explaining what that means shortly. There are no special tax advantages as like compared to entities such as, for example, an S corporation or an LLC taxed as an S corporation. Real estate does get stepped up upon passing, so I've given a nice example here. Let's say we buy a property 20 years ago for $1 million, and later on when I pass away, it's going to be worth $3 million. That will get passed on to my beneficiary at a basis of $3 million, which means that person can now sell the property for $3 million, 100% tax-free. So that concept is called a step-up basis. And so when you buy a property under your personal name or a revocable living trust, that property can step up in basis upon your passing. Now, if the real estate is not ultimately owned under a trust, whether it's a revocable trust or irrevocable trust, there could be costly probate issues. Now, I'm not sure if you guys know what probate means, and I hope you guys never have to deal with it. But if you guys don't have some kind of trust in place, then when you pass away, all of your beneficiaries will be fighting over who is going to get your assets, whether it's cash, stocks, bonds, real estate. And so having a trust in place avoids that, because you're pretty much creating a document that states how your assets will be distributed upon your passing. And it completely bypasses this probate process. Next, we want to talk about LLCs, single member LLCs and LLCs taxed as a partnership. These are really, really, really good for rental real estate, because profits from rental real estate do not come with self-employment taxes. There's what's called a pass-through entity tax election for LLCs that own real estate that generate a profit. And I'll explain to you what that means and what the tax benefits are of this PT tax election. I know like half of you here, I've explained that to you guys already over the past couple of years, but for some of you guys that don't know what that means, I'll be doing a deep dive for that. There is limited liability protection, and real estate under a single member LLC or an LLC taxed as a partnership is eligible for a step-up basis upon the owner passing away. I want to go over what limited liability protection means, because this is one of the most misunderstood topics in real estate investing, in my opinion. So LLCs and corporations that own real estate protect the owner's assets that are separate from the LLC and the corporation, unless the owner was personally responsible or negligent. So I've given a really good example here. Let's say we have a landlord named Larry, and he owns a single family rental that's owned by an LLC. Tom, the tenant, falls on the stairs. He's paralyzed now, and he's out of work indefinitely. So Tom cannot go after Larry's assets, so the tenant cannot go after the landlord's assets, unless the landlord, or Larry in this case, was personally responsible or negligent. So an example of that would be Larry knew that the stairs had termite infestation and did not warn Tom, or he did not take steps to prevent the accident despite knowing that there was some kind of defect in the property. So that would be an example of negligence or intent. Tom, the tenant, can go after the LLC's assets, which the LLC will still own things. For example, it's going to own a bank account which is used to run the actual rental properties operations. It might own a business truck, which people like to use to save on taxes through depreciation, and the underlying real estate. So the LLC will still have assets that will not be protected if somebody falls and breaks their leg. And so at the bottom, I've stated here that it's really important to get a very good landlord policy and umbrella insurance policy to cover damages and protect the underlying real estate, because even if you have an LLC, you're still exposing the actual real estate to liability if something were to happen. Switching gears a little bit here, I do want to talk about S corporations and LLC taxes S corporations. These are really bad for owning rental real estate because they do not benefit from basis step up. S corporations and LLC taxes S corporations in general are really good for generating income that are subject to self-employment tax. So if you recall earlier, when you have an LLC that owns a rental and is taxed as a single member LLC or a partnership, there's no self-employment tax. But when you're in the business of real estate flipping, or you have a real estate management company, that's earned income that will be subject to self-employment tax. And therefore, having an S corporation or an LLC taxed as an S corporation will reduce your self-employment tax. S corporations and LLC taxes S corporations are pass-through entities, and therefore they are eligible to make the PTE tax election, which again I'll be discussing that shortly. And they do come with limited liability protection. The downside with LLCs taxed as S corporations and S corporations is that there's only one class of stock. So if there's, let's say I started an S corporation with a friend of mine. There's 100 shares total. And shares and stock, by the way, they're pretty much the ownership vehicle of an LLC or a corporation, specifically an LLC taxed as an S corporation. So again, let's say I have an S corporation, I own 50% or 50 shares. My partner owns 50 shares or 50%. I have to distribute the profit and capital in accordance with my ownership percentage. So if there's a distribution of $10,000, I cannot keep that whole $10,000. I have to give half of it to myself and half to the other person. It does not matter whether I worked harder than that other person, which is a common disagreement that people have in S corporations. It only matters what percent ownership I have versus another person. So that's a very, very important thing to keep in mind. Real estate owned under an S corporation does not benefit from a supplement basis. So if I own an S corporation and that S corporation owns real estate, when I die, the real estate basis will still stay the same. And that's one big reason why owning real estate under an S corporation or an LLC taxed as an S corp is going to be very tax disadvantaged. And I see a lot of clients making this mistake. Next is a C corporation owning real estate or buying real estate, and an LLC taxed as a C corporation. This is going to be good again for limited liability protection. It will allow rapid scaling without having to worry about issuing K1s. So for example, let's say there's 50 owners of this entity. If you have a past entity such as a partnership or an LLC taxed as an S corp, you have to issue 50 K1s, and all those 50 individuals will not be able to do their taxes until they get their K1s. And so it becomes very burdensome for the person managing the tax affairs of that entity. A C corporation completely bypasses that. There are double taxation issues which come with C corporations. And I think a lot of you have heard that term, double taxation. Like, what does double taxation mean? So when you have a C corporation that makes profits, it's taxed once at the corporate level. So the rental profits get taxed at the corporate level. On the federal, it's about 21%. And on California, it's about 9%. And then when you transfer those profits through dividends to the owners, you pay a second tax, which is another 20 to, it's on the federal, it varies between 0% to 20% depending on your tax bracket. And on California, it's taxed as regular income. The ownership structure in C corporations are more flexible since there can be multiple classes of stock. So when you have C corporations, you can have voting stock, preferred stock, and common stock. And within those 3 types of shares, you can have subcategories. So in that case, I can say, you know what, I'm doing all the work, I should get preferred shares. All profit should go to me instead of these other investors. But of course, no one's going to invest in your company if you do something like that. But there's a lot of flexibility with C corporations. You can have voting shares and common shares. So for example, I can make a C corporation, give myself 100% of the voting shares, and then leave the investors with common shares. And therefore, that will be beneficial for me because I can make all the voting decisions without having to consult other people. And so C corporations, the takeaway here is that they're very flexible. Similar to S corporations, real estate owned by corporations in general, whether it's an S corp or a C corp, do not benefit from a step up in basis when the owner passes away. Only the stock itself does. I just want to make sure I'm kind of clear on what this means, this last point. So let's say I buy a property under an S corporation for $1 million, and after 20 or 30 years, it appreciates to $3 million. Let's say I pass away and my kids or my wife inherits that S corporation stock. If immediately after that they sell the property, they're going to be paying capital gains on $2 million. Where if this property was owned under a single member LLC, there'll be no tax consequences. So when people inherit property, usually that person has bought the property like 20 or 30 years in the past. And so just by picking the wrong entity, you might have subjected your beneficiaries or your heirs to massive capital gain taxes, just from this simple mistake. Next, I want to talk about calculating rental profit or loss and reducing taxes. A lot of people think they know how to calculate rental profit or loss, and so we're going to see if you guys are able to do this and if you guys are aware of all these deductions that you can take. So the first step here is you want to gather all receipts for all expenses, bank and credit card statements, because that's usually where you're going to have all of your income and your expenses come out of. If you buy things in cash, it's still deductible, but you want to have good, clear receipts for those. You want to gather property tax statements and a Form 1098 from any lenders that you have. Once you have that information, you're going to start with your gross rents collected, and then you're going to subtract out all your rental expenses. For example, you're going to have repairs, mortgage interest, property taxes, insurance, and depreciation. I specifically bolded depreciation to see if you guys understand what that means, because there's a lot of misconceptions with depreciation. You will not deduct principal payments. That's a very important concept. So when you're making mortgage payments every month, a portion of that is usually principal and a portion of that is interest. You will only deduct the interest component, not the principal component, because that's non-deductible. Any improvements you do have to also be depreciated. So for example, if you replace your entire roof and you spend $50,000, a lot of clients think that that full $50,000 would be expensed, but no, you have to do depreciation, and we'll explain what that means. But once you have all these income and expenses calculated, the difference will just be your rental profit or your loss. So let's talk about depreciation. Just by a show of hands, how many people think depreciation means loss of value? Yeah, so that's usually what happens. Everybody thinks depreciation. When I ask them what that means, they say, Michael, the property was worth $1 million, now it's worth $800,000. That difference is depreciation. And that is not depreciation for tax purposes. So let's talk about what it actually means. So depreciation is a fancy term for spreading a cost over multiple years, not loss of value. So half of you were technically incorrect. When you buy a rental property, a portion of it is a building component, which is the improvement, so everything above the land, and there's a land component. The land component does not get depreciated or expensed because the land is not getting used. So after 30 years, when you buy a property, the land is pretty much the same land that you had when you first bought the property. So in the IRS's eyes, it's the same land, nothing's happened to it, so it's not an expense. It's kind of like owning stock. You don't expense stock when you buy Apple stock, for example. You just have it. Now, fixed assets such as improvements, so everything above the land, machinery, equipment, for example, washers, dryers, refrigerators, vehicles, furniture, those benefit several years, and so they have to be depreciated. So you spread the cost over multiple years. So in short, the bigger the building component of real estate or other fixed asset, the bigger the depreciation expense. And a common question I get is, how do you even figure out, like when you buy a property, what is building versus land? And so usually you can look at the property tax statement and it'll clearly tell you how much is improvements versus land. To give you guys a a brief idea. So if you go buy a property, let's say in Hermosa Beach, that's mostly land. The land has so much value. The actual building component might be like 10% or 20% of the purchase price. Whereas in places like, let's say, Riverside, the building is going to be a bigger component because the land doesn't really have that much value because of the area. Federal tax law requires that the building component of residential rentals is depreciated over 27.5 years. So you're just spreading that expense instead of in 1 year over 27.5 years. And I'll give you guys an example so you guys can kind of comprehend this. I did make a note here that condos, when you're buying a condo, there's no land. So the whole thing is literally building. So in my example, you buy a property for $1 million. Let's say 50% of it is building, 50% of it is land. The land is not depreciated, so there's no deduction for it. But the building, you would expense it over 27.5 years. And that would give you a deduction of $18,182. And you take that deduction every year for 27.5 years, assuming you're renting it out for the 27.5 years, or until obviously you sell the property. Now, cost segregation and bonus depreciation is a very powerful tool to give you a bigger depreciation expense, which will help you create a loss, and losses are good for taxes because losses are not taxable. So in our previous home, instead of allocating the $500,000 of building to 27.5-year property, we can hire a cost segregation company that's composed of specialized accountants and engineers to subdivide that $500,000 cost into 5-year property, 7-year property, and 15-year property. So a 5-year property would be, for example, machinery and equipment. That would be like your washers, your dryers, refrigerators, furniture, and land improvements. So in this example, I said the machinery equipment is 20 grand, the furniture is another 20 grand, and the land improvements are 150 grand, and everything else is the actual building that's remaining, so that's 210,000. So what that allows us to do is we can take a bigger expense over a much shorter period of time. Instead of waiting the whole 27.5 years, we can front load a lot of that depreciation expense to have bigger upfront losses. And I've just kind of given you a small diagram of like what these guys might be looking for. So the couch is not 27.5-year property, it's 7-year property. Washers and dryers are 5-year. The pool, which is land improvements, would be 15-year property. The special thing with any asset that has a useful life of 20 years or less under IRS standards is that you can do 100% bonus depreciation, which means you can just expense that asset over 1 year. Just expense the whole thing in one-shot deal, and that's under the One Big Beautiful Bill. And so a lot of clients think that real estate might be going down next year, but I think a lot of individuals in real estate that are investing, they're going to be buying real estate just for these tax benefits. And so I don't see real estate going down just because of this tax update. California doesn't conform, unfortunately, so although you can do bonus depreciation on your federal tax return, you cannot do that for California purposes. So when you do bonus depreciation, you'll have a lower federal profit than California.
So since it's 5 years, that you can only do that depreciation for 5 years, or you're doing it all at once?
If you don't make any special elections, then once you do the cost segregation, you would expense the machine equipment over 5 years or furniture over 7 years. But what you can do with this 5-year, 7-year, and 15-year property, because they have a useful life under 20 years, you can expense the whole thing in 1 year.
What happens if you sell before, like you took 100% bonus depreciation, but then you sold the property after 2 years?
So assuming you don't do a 1031 exchange, you're going to add all that depreciation back into income if you sold the property for more than you bought it for, and that's going to jack up your taxes. So that's a very great question.
Between that 5, 10, 7, and 10, where is items like flooring, walls, fixture?
These are examples of 5-year, 7-year, 15-year property, but cost segregation companies will look at every single thing. For example, the electrical components, the HVAC, toilets, everything, and they'll subdivide into 5, 7, and 15-year property for you.
So besides you can claim those under the expenses, you still can get the depreciation over those. If you change the carpet, if you change the flooring for the rental property, instead of, on top of claiming that under the expenses, you can get the depreciation after 5 years on that.
You cannot do both. And so if you look at my calculation for the rental income and expenses, building an improvement, so for example, if you're putting something in the property that's going to last more than a year, like you're putting up walls or you're putting a couch inside the living room, those will benefit the property for more than a year. And so you cannot deduct that. You have to do depreciation because that's a fixed asset. If it's a small repair, for example, like the wall got scratched up and we painted it, that's a repair. But something more permanent, that's going to be an improvement. So changing out the flooring or roofing, adding walls, demolishing walls, those are all improvements, and you can't deduct those unless you do cost segregation and bonus depreciation. I just want to clarify that you don't necessarily have to do bonus depreciation, but that will just allow you to get the deduction all in 1 year. If you don't do bonus depreciation, then of course, instead of dividing a 5-year asset over 27.5 years, you would just do it over 5 years. I hope that's clear. So in this example, you can see instead of taking an $18,000 deduction for the same exact property, this individual is going to be able to take a $197,000 deduction. So I mean, that's literally $170,000 more or $180,000 more. So the key takeaway here is that cost segregation unlocks bonus depreciation for real estate rentals and helps generate bigger front-loaded losses. So you're not creating a bigger expense over the same life. You're just taking that same expense, but just shortening when you can take it. And then now we need to see, once we have a rental loss, can we even use the loss? Because what happens if you have this $200,000 deduction and you can't use it? So we need to kind of do more analysis to see, can we use this loss to help us save on taxes? Or are we just going to keep carrying it forward to offset future rental income? So I'm going to discuss the tax implications. But before I do that, I want to just show you guys how this looks on a tax return. So when you own a property under your individual name or a revocable living trust or a single member LLC, it looks like this. And so basically you'll see at the top, you have your rental income here, and then a breakdown of all of your expenses, including depreciation. And the result is that you have either a net profit or a net loss. And now my favorite part, tax reduction strategies for rental profits and losses. So we can actually save on taxes if we have profits, and we might be able to use losses to save on taxes as well. So let's jump into it. So the first major question that you guys should all be asking yourselves is, can rental losses offset other taxable income? A lot of us don't just have a bunch of real estate rentals. We might have W-2 income, might have business income, might have interest, dividends, capital gains. So can we use rental losses against other taxable income? And if not, what happens to it? So if our income is $75,000 or less, specifically the modified adjusted gross income, if we're single or married filing separately, or if it's less than $150,000, if we're filing jointly, and we significantly involved in the operation and management of the rental activity, then we can deduct up to $25,000 of the rental losses against other income sources. For most of us that make over $150,000 if we're filing jointly, or $75,000 if we're single, we're kind of stuck. You know, we're spending all this money buying a property, generating these losses, and we can't use them in that current year to offset W-2 income or interest or dividends. We have to carry them forward to offset future rental profits. Now, that is going to be key for many of us. Lots of my clients, honestly, because they live in California and they're making a lot more than these thresholds, they're not benefiting from buying rental real estate. Unless they're going to qualify for one of the two exceptions, which we're going to talk about shortly. I want to discuss phase-outs. I will kind of gloss over this because many of us are not in that threshold anyway, but assume you're making $50,000, between $50,000 and $75,000, if we're single or filing separately, or $100,250, then this $25,000 of loss that we can use against other income, like W-2 or interest income, that a smaller portion of the $25,000 can be used against those other sources of income. So I'm not sure if that's kind of clear. So let's just say, for example, I make $62,500 and I'm single. Half of this $25,000 would be deductible against my W-2 or interest and dividend capital gain income. The rest would be carried forward to offset future rental profits or until I sell the property. Pretty much, if you're within the phase-out range, so $50,000 to $75,000 if you're single or separate, or $100,000, $250,000, like for example, let's say $125,000, only half of this $25,000 of rental losses can be used against other income sources. So the closer you get to $150,000, the less of this $25,000 limit can be used against non-rental income. For losses that are phased out, again, rental losses are suspended, which means that they are carried over until there's rental income to offset rental losses. So if I have a $20,000 loss that's phased out, I can still carry that forward to next year and offset rental profit until I use it up. or until I sell the property. So again, what does this mean? We go and buy this rental property that's $1 million, let's just say. We've put in 20% down in most cases. We've taken a big fat loan. We've spent money on repairs, spent money finding a tenant, potentially agent fees, maintenance costs, and we cannot use it if we're making more than $150,000 as we were married. So that hurts, right? What the heck's the point of buying this rental property if that was what's going to happen? So luckily for you guys, there's 2 exceptions that you might be eligible for. The first is real estate professional status. So if you qualify as a real estate professional, then rental losses are deductible against other sources of income. So you can freely use the losses against W-2 income, business income, and so on. Now to qualify, a lot of clients think that a real estate license is necessary to qualify as a real estate professional, but that's actually not true. So the first criteria is that the individual has to spend more than 750 hours or more in qualifying real estate activities. So the 4 categories or 5 categories are property development, construction, acquisition, rental operation, and management of the rental activity. And the second criteria is that more than 50% of all services performed in any business or trade, including W-2 jobs, must be in real estate activities. So unfortunately, if I'm a W-2 worker as an attorney, I have to spend more than the time that I spend as an attorney in real estate activities to qualify as a real estate professional. So for that reason, most professionals in non-rental real estate activities will not qualify. So those are your doctors, your lawyers, engineers, consultants. We will not qualify for working full-time in these non-real estate related activities. The way that a person like me might qualify is, let's say my wife is a physician, she takes 1 year off, and she manages our rental real estate, then she would qualify because all of her time would be in rental real estate activities. But she would just have to meet the next test, which is more than 750 hours managing the real estate activity.
And then you just automatically become that? Or
That's it. There's no test, there's no nothing.
you qualify yourself?
You have to keep good records to prove that you've spent these hours. So what I recommend for clients to do is make some kind of log, basically some kind of simple Excel spreadsheet, which shows every day that you spend on real estate. For example, on January 7th, I spent 2 hours buying supplies at Home Depot, or I spent 3 hours looking at insurance policies and interviewing contractors. So if you make a log, that's how you can check these hours. In case you get audited, that's what you want to give to the IRS to prove this. The easiest way that clients qualify this is not usually themselves if they're not in real estate, but it's usually if they're working part-time, or a spouse that's working part-time, or a spouse that's obviously not working. So that could be a talking point for spouses. But again, a real estate license is not necessary. There's no tests you have to take or anything. Next is the short-term rental exception. So this exception is why a lot of clients were buying properties and using them for Airbnb the past couple of years. So short-term rentals can be treated as businesses, and those losses can be used to offset other sources of income. Again, for example, W-2 interest, dividends, and so on. Now, unlike the real estate professional status, which only works for the federal, losses from short-term rentals will help you in both your federal taxes and your California taxes, so it's better. Now, to qualify, there's an average length of stay for guests criteria, and there's a material participation criteria. So the first is, if the average stay of your guests is 7 days or less, you automatically qualify, provided that you materially participate. If your average stay of guests is more than 7 days, but less than 30 days, for example, it's on average 10 days or 15 days, then you have to provide substantial services, for example, daily laundry and cleaning services or concierge services. Just having an Airbnb and changing out the bed sheets in between guest days will not qualify as substantial services. So it would have to be daily laundry services or daily concierge services if the average stay is more than 7 days but less than 30 days. The next criteria, which is not too bad, is the material participation test. There's 7 tests, but the most that clients use to qualify are the 100-hour test, 500-hour test, and substantial participation test. What that means is that if you manage the property or the rental activity for 100 hours and no other person, like a management company, spends more time than you in that activity, then you qualify for this. Otherwise, if you have a rental management company, you have to spend at least 500 hours to qualify for the 500-hour test. And if you don't meet any of the other tests, there's a substantial participation test. So you're the only person doing everything in that activity. That's another way for you to qualify. And again, short-term rentals allow you to use the losses for both federal and for California purposes. A common question I get about real estate rentals is, can you use the property as a primary residence 1 year and then later convert it as a short-term rental or long-term rental, or vice versa? Like, can we change the use from 1 year to another? And the answer is, yes, you can. If you buy a property as a short-term rental or a long-term rental, do a big bonus depreciation, those losses will still carry over forward if you don't use them, even if you later convert that property into a primary residence. So that's a very good point to keep in mind, and that's why in the beginning I said real estate is really good because you have full control over it and you're very flexible with the use that you can use for it. So I kind of talked about what can we do with rental losses. So if we don't meet exception 1 or exception 2 for real estate professional or for short-term rentals, then again, those losses are carried forward to offset future rental profits or until we sell the property. But what do we do when we have rental profit, and how do we save on taxes on rental profit? The first thing I want to talk about is the qualified business income deduction. So if a rental activity is classified as a trade or business, you may be eligible for up to a 20% deduction on your federal tax return under Section 199A. So if you generate $100,000 of profit, let's just say, up to 20% of that, or $20,000, you can just wipe off and not count that as income on your taxes. To qualify, the rental real estate must be conducted as a trade or business with a clear motive to generate profit. So your intent cannot be to use this property for personal use. It's a very low threshold to meet, or a low bar to meet. There are phase outs. So if you're single or married filing separately and you're making over $247,300, or you're filing jointly and your income is over $494,600 for 2025, then you have to worry about limitations. And the limitation for practical purposes is pretty much 2.5% times the unadjusted basis in assets, which just is honestly the purchase price of any assets that you have, is the way to think about it. There's a 25% of W-2 wages limitation, but usually people don't just buy properties and hire employees to manage the property for them. So this will usually not apply to most people. But theoretically, if you want to increase your limitation, assuming you're making over $500,000, if you're filing jointly, you can hire employees under your rental property to help boost it up if your 2.5% limitation is not enough. So Charles has no employees. He bought a $2 million single family rental property. He's married, his wife is Linda, and they make a combined adjusted gross income of $800,000. Of that, $300,000 is rental profit. So assuming there's no assets limitation, which is this limitation here, he can take up to 20% as a qualified business income deduction, which is $60,000. But because he makes over this $494,600 threshold, he has to do this computation to take 2.5% of his assets, which in this case is just the $2 million property, and he'll be limited to just the $50,000. So again, this limitation only applies when you make above these thresholds, is the key takeaway here. Losses from one qualified business can offset income from another qualified business. So I gave a really good example here. Let's say Linda had an analytics research company with a business loss of $300,000. Because she'll have a business with a loss and a rental business with an income, they'll offset each other and you'll get 20% of zero as a qualified business income deduction, which is just zero. So keep in mind that if you or your spouse has a business that has a loss, that's going to hurt you for this qualified business income deduction. Next, I want to talk about the pass-through entity tax election. This is a really big one. Luckily, all my clients here are taking advantage of it. So, I mean, good for you guys. For the ones that aren't, I'm going to explain it to you guys and hopefully you guys can benefit from it. So the eligibility criteria for the PTE election is the rental real estate activity must be owned by a pass-through entity. Pass-through entities are usually LLCs taxed as partnerships, LLCs taxed as S corporations, partnerships, and S corporations. Single-member LLCs do not count as pass-through entities. So sometimes when clients are making a lot of rental profit and they're married, it's usually good to make a separate husband-wife partnership. so that they can make this election. Or maybe sell a portion of their interest to somebody else so that they can have this partnership status. To make this election, you have to just pay $1,000 to the Franchise Tax Board if this election is in California by June 15th. Or you have to pay 50% of the previous year's PT tax. So if it's your first year, you would just pay the $1,000. Every year after that, you have to pay 50% of the previous year's PT tax to make this election. And the rest of it, you'll just take 9.3% of the entity's profit, and then you'll pay that when you file your tax return, assuming it's timely filed. So for pass-throughs, usually those are due March 15th. With an extension, they're due September 15th. Now, the ultimate benefit of making this PT election, like why do you want to do this? It's because you'll get a federal tax deduction for state taxes that would otherwise be partially or fully limited. So imagine you're going to be paying a California tax and not getting a tax benefit for it. This election pretty much allows you to pay California taxes and get a tax benefit for it. So again, I gave another example with Mr. Charles here. He has no employees and he bought a $2 million single family rental property. His rental profit is $300,000. So the PT tax will be 9.3% of the rental profit, which is $300,000, which gives you a total tax of $27,900. Assuming his marginal rate is 37%, his maximum benefit will be $10,323 just for making this election. Whereas if he did not make this election, he might still be paying the same exact amount of tax and not getting a full benefit of it. The next thing I'm going to talk about is bonus tips and preparing for success. And this is just from years of experience, just things I want to let you guys learn about so that you guys can make more informed decisions. If you live in a primary residence for 2 out of the last 5 years, you can exclude up to $250,000 if you're single or filing separately, or $500,000 if you're filing jointly of your capital gains. So let's say you buy a property for $1 million, you're married and it appreciates to $1.5 million, you're paying 0 capital gains under this $500,000 capital gain exclusion. Now, it's important to note that if you have a property as a primary residence and convert to a rental, then you still get this full capital gain exclusion if you lived in it 2 out of the last 5 years. But what people don't know is that if you do the opposite, this capital gain exclusion can get limited. So if you buy a property and rent it out first, and then, let's say after a couple of years you decide you want to live in it, that will limit this $250,000 or $500,000 capital gain exclusion. So choosing one before the other is very important in tax planning. If you have a rental property that has appreciated, and if you sell it, you'll be hit with capital gain taxes, you can do a 1031 exchange, which will defer the gain. You're pretty much pushing off to a future time. But to qualify for this 1031 exchange, you have to sell an investment property, roll over the funds to another investment property. And you have to use a qualified intermediary. So you can't just sell a rental property by yourself and then buy another rental property. You have to hire a qualified intermediary to facilitate the process for you. It's very important. And you cannot use a 1031 exchange for a primary residence. That's a common question that I get. When you sell a property, assuming you sell it for more than you bought it for, depreciation that you took in previous years will be added back. So you definitely do not want to buy a property as a short-term rental, do a big bonus depreciation, and then the very next year sell it, because all that tax benefit you got in 1 year is going to get added back the next year, which defeats the whole purpose. This is an important one that is extremely important as well. Property bought by a married couple in a community property state, which California is one of those community property states, should be bought as community property to get a double step up. So what that means is that, let's say there's a house that I purchased for $1 million and I buy it as a community property. When I die, my spouse, in this case Anne, will be able to get a double step up. So not just my interest will get stepped up, but both of our interests will get stepped up. So if the property at the time of me passing is worth $2 million, she'll be able to sell the property for $2 million and avoid taxes. Now, let's say you do something crazy, which I've seen clients do from not getting good advice. Let's say you buy this property as tenants in common, then only my half will get stepped up, not my wife's half. And so that could be a very costly tax mistake just by how to title the property. The real estate professional status test, which is the 750-hour test, and the short-term rental material participation test, is applied on a per property basis. So what that means is that for each property you want to claim this loss for, you have to meet this 750-hour test for each property separately. You can't just have 5 properties and claim real estate professional status for each of them unless you spend, again, 750 hours for each property. Now, the only exception to that is if you group them into one activity, which that's an election you have to make with the IRS. You can't just say you've grouped them. You have to actually file a election statement with the IRS. But there are potential drawbacks related to existing or projected suspended losses. So if you're going to try to group these rental properties together as one activity to qualify for REPS or short-term rental, then you just want to just be careful that you're fully utilizing suspended losses first. Otherwise, you might not be able to use them. A lot of questions I get are related to irrevocable trusts. These are really good for advanced limited liability protection and estate tax planning strategies. But these are usually really applicable, in my opinion, or they're most effective when a client's estate is projected to be more than $14 million per person or $20 million per couple. Otherwise, if your estate's going to be less than this, which estate is a fancy word of just saying all the assets that you own under your personal name or under a disregarded entity, as long as it's below these thresholds, you can usually use an LLC or an S corporation or a C corporation or some other pass-through entity to get the same limited liability protection. It's not going to make sense to incur the additional costs of making these fancy irrevocable trusts, and they do have drawbacks that come along with them. On that note, I just want to give my closing remarks, and then I'll open the floor for general questions and answers. I do want to thank you guys for coming today, and I want to thank my wife especially. She took my PowerPoint presentation, spent hours on it to make it more digestible.
Thank you.
If it wasn't for her, it'd be technical jargon. But yeah, thank you so much, guys. Really, really appreciate it.